Hi, welcome back to FutureFast, and we have once again managed to get Loretta to come and sit with us for the second time. And today we have lined up quite a few things to talk to her. And before that, those of you who are here for the first time, obviously you've missed Loretta's journey, which is you just have to listen to it. So I will not say anything more to that because it just touches about pretty much every continent, and you will not regret having not having sit through that, and perhaps you will also listen to it once again. And also I urge you to share it with those all your network, because this is just not about Web3 or blockchain. Her conversation is very interesting. Her journey, I'm sure, will be found interesting by a whole lot of people, even those who are not into Web3. And with that, like always, I'm sure you will enjoy this conversation also. And Loretta, once again, thank you so much for making time. Welcome back to FutureFast.
Thank you for having me. I'm sorry I've been so busy. I wear a lot of hats and I have a lot of roles.
Yes, and those of our listeners who are following from the past, I'm sure they already figured why. So, Loretta, I know we have very little time, so let me just jump into our conversation. So, first thing is, let's talk about, as we discussed, about the areas where Web3 is from a point of monetization and business and opportunity. To start with NFT, what's your take on NFT?
So, I guess I've got a few probably argumentative points on NFTs. So I think I see a lot of parallels with how I saw the initial coin offering boom in 2017. There's a lot of hype. There's a lot of people that are jumping into this NFT because it's a hype word. They're not actually understanding exactly what an NFT does. So a non-fungible token. Why is it called a non-fungible token? So the fungibility thing is an interesting question. So dollars, so money we call fungible. So I can change some Indian rupee from Australian dollars. That's the fungibility of money. A non-fungible token means that we can't exchange one token for another. And what I mean by that, the non-fungible tokens have been used a lot. We've heard a lot about them in the last year to digitally verify proof of ownership of anything from, say, a pair of Nike shoes that Michael Jordan owns to a building block or a piece of art. So in non-fungibility, the best example I can give practically is, say, one Picasso is not equal to another Picasso painting. So that's what we call non-fungibility.
Right. Or even a Jordan Air shoes, which is signed by Jordan, if it is only one exclusive pair.
Yeah, and a lot of people have jumped into this space, and you've already got to break it back down to principles. So a good example too is, if what means something to me. People collect all sorts of things, stamps, coins. My little girl, when she was a child, used to collect snow globes, those little buildings you could turn up and down. There's been a collectibles around. This non-fungible token sort of hype came from collectibles and from art to start with and it's all powered by the blockchain technology.
So do you really think monetization of NFT from art collectibles? How do you see that?
So I think the jury's still out. As I said, I see a lot of similarities with the boom and bust cycle we saw with ICOs in 2017, which were a lot of scams, with what I said with the non-fungible token world. But the thing I do find interesting is, so it's like having me go to and have what is unique to me. It's like me getting a autograph of the Prime Minister Modi. Now, there can be a crowd of people. I can put a piece of paper out. He can sign that piece of paper. Now, that is important to me, but that may not be important to somebody else. The interesting thing about a non-fungible token is that we can have that digitally represented, something that I find important to me or I like to collect, but with utilities. So Michael Jordan, electronically you could have a non-fungible token in the form of a pair of his shoes, which you owned as the individual owner. There's very specific, and it has utility rights attached to it. So you might be able to get a half an hour basketball session with Michael Jordan as your coach, or that's the difference between, I guess, the real world idea of, say, a signed piece of paper or a signed pair of shoes from somebody.
You're familiar with a European company, I'm just not getting the name, where they have partnered with a bank, a European company which is into art trading. They have partnered with a bank.
Yeah, so a lot of it, but it's an interesting thing. So people are now using non-fungible tokens to digitally represent the uniqueness that they own, say, a Picasso painting. But you don't actually own the Picasso painting. You own the rights, the digital rights to that painting. So I think, and so it brings up a lot of problems around IP. People are selling.
Well, how they are managing it is in the parlance of tokenization, right? So they are essentially digitizing that art.
You're digitalizing
and drawing up a tokenomics around it, and fractionalizing the tokenomic earnings, and then they are distributing it, but auctioning it as NFT. So we can own a fraction of that art as an NFT, but which is representing the digital asset, which is a real art, which is actually in the lockers of the bank, which is a partner to that. It's a Switzerland bank, I think, which is set up an exclusive bank.
It gives you the digital rights, so you get actually rights attached to that digitally, and that's
alternately, how I think it works is that whatever the revenue that art makes, right? If it is showcased in a museum, there is a fee charged by them. So if you own a fraction of it, you earn out of that. So it's not just a collectible, but you actually earn like a digital asset.
So I'm actually an NFT.
So is this a fair thing to call this as an NFT in that context? Because this is technically tokenizing of an asset.
It is. It's the first sign. It's the first application we've seen of tokenization of assets, and these NFTs, of any asset, whether I said it be a pair of Michael Jordan shoes or a Picasso, or a land title, or real estate, or water, or bottles of water. The people are tokenizing all, like the superstars are using. I think if Salman Khan's got an NFT, which gives people right to a digital representation of a signed autograph, effectively digitally by Salman Khan, and maybe that gives them the right to have lunch with him or something. There's utility rights attached to these digital tokens. But the issue I see, and a lot of people are starting to look at it. There's a lot of hype around it. Are they going to make you as much money as people seem to think? Because people will always buy something if they think they can sell it at a higher price. We've seen everybody from Gucci to a lot of the big brands, the cosmetic brands, go into NFTs. We've seen NFTs promoted by American footballers, by Bollywood stars. The ability to tokenize any asset, and there's non-fungible.
So I think my take is why they didn't monetize as much, right? Is because that NFT did not reflect the tokenized asset aspects of it, right? So because it was only a keeper, or like you said.
So it doesn't actually mean you own the piece of Picasso in the museum, and a lot of people thought it did. But you own the digital representation, the digital piece of code that says you digitally own.
It's just a keepsake.
Yeah, as I said, it's best akin to something like a digital, autograph.
So where do you rank it from a digital asset standpoint? How do you rank this?
So there's been a lot of hype about these things, and I think it's becoming, for me, I've seen a lot of similarities, as I've said, around ICO booms. Now, a lot of people buy art and wine and expensive watches and many things for what reason? Number one is tax evasion. So these things are seeing a lot of movement for tax evasion, and that's a red flag to me from day one. Not all, of course, but we are seeing, and the holders of these non-fungible tokens, what we called back in sort of 2016, 17, when there was what we called whale wallet holders. So these very big guys that hold a large amount of a cryptocurrency, or they held a large amount of a token in these initial business offerings. The same wallets are holding large amounts of these NFTs and selling them at a higher price. So a lot of these I would call, as we call it in the industry, a pump and dump. So you buy it and you sell it to somebody else on with just a speculative agenda. And to be honest, that's what I think they are. So a lot of mainstream businesses and brands tried to jump into this, but they haven't seen the monetization like they thought it was going to be seen. And we'll get into about the metaverse as well, because I think there's a good correlation there. But the other point of these non-fungible tokens is, just because something is non-fungible doesn't mean it's outside the law. And there's a big discussion at the moment about what non-fungibility means. I've just explained to you that a dollar bill is fungible for another dollar bill, but a Picasso painting is not fungible for another Picasso painting. The issue I see in any of these tokens and the world of tokenization in these digital assets is, what are the rights attached to when you buy a token? So when I buy an NFT, am I buying it for the sole purpose of trying to sell it at a higher price? If you're doing that, and this is an incredible warning to everybody out there, I will tell you right now, you're in breach of securities law, because there's a rule that comes out of 1946, I believe, something in American, the Securities Commission of America, which is equivalent to SEBI, talk about the Howey test. And it's about, it's an interesting law case, and anybody who's interested in this probably should go and read this Howey court case in 1946. You can just Google.
How do you spell it?
HOWIE. And it's used as the principal point of law to work out if something is a security or not. So this was about an orange farm that was fractionalized and it was sold off. But the sole purpose of people buying into this sort of timeshare was because it was an investment with the purpose of making money. So regardless of whatever the technology is, whatever fluff you want to put around non-fungibility, most NFTs I've seen are actually securities, and you will see security regulators come down on these very, very hard. The other problem is that we're now seeing, like we saw with initial coin offerings, we're seeing a lot of money laundering and a lot of movement of money, laundered funds and proceeds of illicit crime move into these things, because there's not a lot of what we call KYC, know your customer, to get into these non-fungible tokens as you would when you're going to open an account at a bank or at a telecom. You have to do what we call KYC. So we're not seeing a lot of that. And the Financial Action Task Force, which is the global standard setter for money laundering, terrorism financing, have said if an NFT is an equitable, like an antique or a painting, there is rules around that under the FATF guidance around money laundering for things, for precious art and expensive goods. So they're already covered under that. But they're also saying if these non-fungible tokens are used as a payment for something or a source of investment, you have a money laundering, terrorism financing responsibility. So everybody thought
we had a instance, very well-known politician acquired a art piece by a very famous artist, an Indian who's no more, for 28 lakh rupees, and later on sold it for 2 crores or something, which is like about 10 times more.
Was that the Hussein painting?
Yeah, it was Hussein. You're familiar with India. You would know. I have a
very small sketch of my daughter when she was very good that was done by Mr. Hussein, who was a friend of mine, done on a serviette. So I will always hold that clear, but I've never sold it. But yeah, so that was a very good indication of money laundering. But we see when people buy expensive art.
Well, incidentally, there was no case. Every politician talked about it. They did then allege that it is an indirect form of bribing. Why else? But there was no case on that. But it is the same context you're referring to in what people do it in the industry.
And I think we'll see, and then there's the other biggest problem I see with non-fungible tokens is the IP, the intellectual property rights about these tokens, because how can so I'm actually a non-fungible token. There's something called OpenSeas, which do digital art, and it's a platform that's creating a lot of money. So these non-fungible tokens are in art collections. There's the things known as an ape collection. Why, I don't know. There was something called the crypto drunks and the crypto punks. I think I'm number 9 crypto drunk. And I was just somebody, somebody designed this digital piece of art that was me with the regulations hat on. I think in my series there was Vitalik Buterin and Andropoulos, CZ. I was up there with some quite famous people in crypto, and I was crypto punk number 9. Somebody bought me for 2 Ethereum. I don't know who or why or what. So I was very puzzled at the time. And there was this bidding war for me for this digital art cartoon figure of me. So I don't know who owns that or why they own it or what they've done with it. But so I found that was very interesting that I was used as a test case. But I don't see them in the form they're in at the moment being able to monetize as much as people thought they would. And I think when regulations come into this, and a lot of these non-fungible tokens are seen as ways to launder money, as ways to be tax dodgers and to be actually securities without actually being a security, the likes of the SEBIs and the enforcement agents.
But if we attach securitization to NFTs, perhaps it makes more sense. What do you think about that argument?
Yeah, I mean, I've got an interesting case at the moment where I've seen a non-fungible token for digital land. Now, this is becoming a problem because the non-fungible token issues actually don't own the land, and they're selling digital land as real land, but they don't own the land. So this is going to be a problem with real world assets that have been tokenized.
True.
How do you prove that you own them? If there's people just creating non-fungible tokens and there's no tangible asset behind it, they're not going to be worth anything. So I think these things will start to come into the court of laws very, very soon because they're becoming quite problematic. And
is there any recommendation you're doing? Because I'm consulting for someone who was originally looking at creating NFTs. So I'm associating it to securitizing those things to their creative work, is basically an author. So associating it to creative work and drawing up a tokenomics based on the earning of that book sales.
Yep.
So this NFTs, what they want to give out, they get a share of every time the book, as an author, what he earns, a share goes to these people. So from that respect, the value keeps recurring every time.
And it's good. It's in the context of artists and authors and musicians, for example. But I see better ways to.
But we don't have a rule here. See, I can't even use it as securitization because here in India, security term is employable only in the context of money.
And securitization.
So I'm trying to go around it with smart contracts, because technically in India, even smart contract is not illegal. So I have to do a layer of backing up with a legal contract conforming to the smart contract.
And just for those of you who don't know what a smart contract is, a smart contract is neither smart or a contract. It's just executing code. So it says, if A and B happen, you can do a transaction. So it's a very efficient way of having a contract digitally executed, I guess.
But in Europe, it's becoming a smart contract will be accepted as a legal contract as well, right?
Yeah, but the problem is that the new legislation coming out of Europe, there's a legislative bill called MICA. They're actually looking to have a kill switch on a smart contract. I don't agree with that. So these things could actually in law be
what do you mean by a kill switch? How does that work?
A kill switch, they'll just kill the contract. The contract will be null and void.
No, but then how does it serve the purpose of smart contract is as good as a legal contract?
But then it doesn't work then. So it's like taking a legal contract. It'll be in the terms of a legal case with a contract, somebody not validating a contract, then going to law. So it'll just revert back to the old way that you'll have to go to court in the way that you've always gone to court. So it really takes out the the ability for a smart contract to do what it does if you can have a kill switch. And in a decentralized world, this executing code takes out the need for trust, because when you have, in the real world and you have a contract, you usually have an accountant. If you buy a house, you have an accountant, you have a lawyer, you have to go and sit in the registry's office, you all have to sign it, it costs you money. The way that we've done contract and contract law works in the real world is very costly, it's very inefficient, and it takes a lot of time. To be quite honest. So smart contracts allow transactions to be what we call atomically swapped. So we can do a transaction on the blockchain using a smart contract, which was created by the Ethereum blockchain, as executing code, which executes the contract as the conditions in the contract are met. Now, if you have a kill switch that you don't allow these transactions to use the smart contract function, you sort of defeat the point, the purpose of the Ethereum blockchain.
No, I'm just thinking loud. It could be meaningful, right? If the kill switch is from a point of defining a time frame.
It'll be from a regulator. A regulator will have the ability to have a kill switch on a smart contract. Right. So if a securities regulator or a prudential regulator deem this project to be illegal or not in regulatory compliance.
No, or even in a decentralized ecosystem, if it is a smart contract between you and me, if both of us can agree to terminate that, that should be able to work good, right?
Well, no, because on a blockchain, it's an immutable, transparent database. And once the smart contract is executed, it's very, very hard to...
No, it is correct. Yeah. So, but if both of us, the smart contract is always between, the parties involved, right? Like
or the code. But smart contracts can now be between algorithmic codes. So this becomes much more complicated. I can... In decentralized...
Correct. No, but it can be bound for a time frame. It can be bound for a particular outcome.
Yes,
context.
You can put any parameters into what the smart contract is to fulfill.
So even the kill switch can be built into that itself, right?
But it can be built into it, correct. But should regulators have the regulatory or the legal ability to kill a smart contract?
Oh, well, that's something we need to debate. But how else will you bring in better acceptability? Because at this point of time, keeping it in grey is keeping a lot of real businesses out of it.
Yeah, but I think the whole purpose of decentralized networks and smart contracts, the one thing Ethereum brought to the world was the smart contract, the ability to execute the transaction.
It's great, but it's working in a very small population. But if you want to have most of the people, you know what's happening in India, right? Most of the businesses are moving out of India, setting shops. Some of them are setting up shops in Singapore. Most of them are going off to Dubai.
That's because you've got no legal clarity. There's no regulatory legal clarity.
So for us to bring in legal clarity, we need to have this compliance guys looking into it in some manner, some sense, even if it means...
But I don't think in the nuts and bolts of the deep technology understanding of regulators. And yes, regulatory...
They don't have, but somewhere we have to bring in. Otherwise, how will we bring in mass adoption, which is a necessity, right?
Well, I think mass adoption... So there's two sides to mass adoption, and one comes from legal clarity and regulatory clarity. And the ability for institutions and businesses to trust in the technology. Now, the technology itself, blockchain technology, is still pretty new. I mean, I've been in it, for 12 years, and people often tell me that they've been in blockchain technology for 15 years, 20 years. I'm like, well, did you create Bitcoin? Because Satoshi Nakamoto wasn't around 20 years ago. So if you've got 20 years experience in blockchain, you're lying. But so this is still a very new technology. I mean, smart contracting only came into existence when Ethereum was born in 2012. That's 11 years ago. The technology itself is still quite nascent, and the applications of things like non-fungible tokens, cryptocurrencies, are still highly speculative. They're highly volatile, and they're very unregulated. And for social adoption to continue, and therefore for businesses and investors to be more confident in this market, we need parameters of regulatory frameworks. But the other thing is that laws need to be technology agnostic, and I don't think regulators should be regulating technology. I think they can regulate the services that are built on top of technology, but you can't regulate technology. So to have the ability of a regulator to have a kill switch on a technology is not what regulators are in place for. Regulators are there for three reasons. Security regulators to protect consumers, investors, and to stop frauds. Prudential regulators.
I think, I agree with you. I think most important thing is that they cannot have a kill switch at their hand, but perhaps they need to have a say in at what point of time for an arbitration, if there is a contest, right? I mean, if you challenge it saying that we had agreed that this kills at this point of time, and one of us disagrees at that point of time because it was already stated there, well, then we need a resolution. That is when it goes to some level of arbitration.
But at
that
the
is where you
moment,
need
regulators, the kill switch is if protocols go belly up, like we saw with Terra Luna. So when I talk about the smart contract kill switch, is when the stablecoin Terra Luna and the debacle that was, we can get onto stablecoins in a minute, the smart contract didn't work because everybody puts so much faith in algorithms. Algorithms are never bigger than the market. It doesn't mean the market will always be bigger than one side. Algorithms don't always work. Technology can go belly up if somebody puts in the source code wrong. I mean, there was Ethereum when it was first created did something. They did what we called the first ever decentralized automated organization, and that had a lot of money put into it from the Ethereum coders that were all part of the network. And in these public networks, Ethereum is governed by everybody in the network. So nobody controls the network in public blockchains. It's what we call the consensus mechanism. Everybody, if you change the protocol or the rules of the protocol, you have to have consensus that everybody needs to vote to have that done. In something like Ethereum, it's 51%. So you have to have 51% consensus to change the protocol. In Bitcoin, it's a lot higher. It's about 70%. So 75% of the network have to agree to change the rules for the rules to be changed. You can't just change the rules in these databases if you're a big player or because you can't control. But we're seeing as decentralized comes and when there was a DAO on the Ethereum network in 2012, that code got hacked, that source code got hacked, and Vitalik Buterin just changed it. So is Ethereum, the argument could also be, is Ethereum as decentralized as it say? Are some of these protocols as decentralized as they would say? So when these protocols are meant to be governed by maths, we believe that 1 + 1 = 2. They're not governed by people, and that's been the whole, I guess, predicament of what decentralized is. That no longer do we need third-party intermediaries or people in systems. We trust in code. We trust that maths will allow these trustless systems to not involve trusted parties.
So with this AI, it becomes much easier because they will align to these things than human intervention, right? Human intervention is, there is always a scope to manipulate things. So machines can stick to the algorithms because this is the rule. I just have to follow. Your human emotions can change that.
I mean, that's the different thing. I mean, I think I was watching a clip from Elon Musk in 2018, and he warned, in 2018 that AI was going to become the menace to humanity, and it was the demon that was let out of hell. And if you look at that today, where we're sitting, I think he's probably right. So, are we ready for a world where algorithms control it, where everything is trustless? We rely on code and trustless systems to operate in a manner that is fair and equitable. I think in blockchain, yes, but when we start to see AI and blockchain technologies and Web3 and
it's an eventuality, right? We can't keep them away separated. It is bound to come together.
And I think it will be a problem for humanity going forward, because do I really want codes and algorithms to control everything?
Loretta, I would like you to keep this conversation for the third part of it for the future. So we'll get back to.
Let's not get off that. So, all right. So we've done the non-fungible tokens. So in most cases, non-fungible tokens are not going to make you money. They're very speculative. If you want to go and buy a digitally represented ape in a picture and you think somebody's going to, for $2 Ethereum or $2,000, and you think you can sell it for $10,000, good luck to you. as we start to see tokenization of real world assets and people using these non-fungible tokens to do that, this is an evolving space. It will get more sophisticated. Innovation will be.
We continue on the tokenization and then come back to metaverse, because I think it's anyway contextual. It's in sync with the conversation.
I think, what we saw with Bitcoin was the tokenization of money. Yeah, as I said to you before, money means a different thing to everybody. So we won't go into that. But what we're seeing now, and a lot of the standard setters and governments I talk to, there's a lot more mainstream businesses and mainstream adoption of tokenization of real world assets. So now we can tokenize a bar of gold. Now you think about, I'll use gold in the Indian context. Every grandmother in India, every auntie, every massie owns gold, wears it. Gold is the most illiquid asset. It has always fundamentally thrown me off. I own gold, but I own it as a store of value. People buy gold, people love gold, but to sell gold is a very, very difficult thing. It's very illiquid, it's very heavy. You've got to take it to a gold person. What can you do with your gold other than put it in a vault or wear it? Not much. So it's a very liquid asset. So you think about if we could tokenize the gold, and when I mean if we could
Loretta, to start with, paper money was very much tokenization of gold or silver to start, silver and gold.
Well,
every country till 1972 or 3, when the US
Nixon got rid of the gold
standard. The most infamous president is famous perpetually for doing this.
but before we even had gold, we used to barter, potato. Someone would barter a potato for rice.
We've always had tokens, right? We've had different materials. In fact, China had paper currency 1,000 years ago. They did dabble with that. I think one of the Qing dynasty or one of those dynasties had paper currency for some point of time. So,
and they used to use in South America cocoa beans. Cocoa beans was a form of money and for thousands of years in South America. So tokenization of real world assets in this form using a blockchain technology is important for two reasons, because it means that we can
for thousands of years we have done tokenization, so it's only a logical thing.
Yeah, but that tokenization at that secondary market function, and when I talk about a secondary market function, so when I buy a piece of gold, I have to go to another market to sell it. It's a physical thing. Now that process in primary market, so if you trade equities or you trade fixed income, you trade them in the primary market. That can be quite fast on an exchange. You swap the asset.
Oh, no, that is what the blockchain enables today, right?
Yes, and the thing that the blockchain enables on this tokenization of real assets is that instantaneous transfer of that asset atomically. So it's when the asset is atomically swapped. And then you can trade in the secondary market, because the biggest problem with markets globally, and any market, whether you're talking about fixed income, commodities, equities, is the liquidity. How do you find someone to buy your gold, or how do you find someone to buy your bond? Liquidity has always been a big issue. But now that we can atomically swap assets, you can bring liquidity into what we call secondary markets instantaneously. Now, there are rules in things like equity markets, which if you are SEBI, if you go and buy a share under the laws of SEBI, you can't sell that share out for another 6 months to a year, depending on and different countries have different rules about that. But what we saw with initial coin offerings, as I said, back in 2017, there was no rules around that secondary market function. So these tokens became very popular, very speculative, because you could buy them in the primary market and sell them in the secondary market almost instantaneously with no regulator telling you couldn't do that. So the liquidity function of those secondary markets was
that's banned in most places today, right?
Around your tokens, but we're seeing with the
ICOs have been banned in that context. Yeah.
Well, no, they haven't. They've just been brought into line. ICOs are now treated in many different jurisdictions in different ways. The secondary market function still exists in a lot of ICOs, but you have to have a proper company. You have to be domiciled.
Which is, I think, it's a fair thing, because there were a lot of scams happening.
Yeah, it was all 90% of that market was scams, and I'll say 90% of what we're seeing in NFTs are scams. The same wallet holders that owned those ICO tokens in 2017 are the same wallet holders that owned the NFTs. But tokenization of real assets actually brings liquidity into markets. So we can now revolutionize capital markets. And all, if we can tokenize real estate, we can tokenize gold bars. If we can accelerate the transaction speed and the ability to trade these things, we open up new markets and new asset classes like we've never seen before. And that, to me, is the most revolutionary thing of tokenization.
You're familiar with gold loans in India?
Yes. I've tried everything. And these things, the gold is I use gold in the Indian context because everybody loves gold. Everybody buys it. Everybody holds
it. Gold loans as a product is the most profitable for your banks, right? I think pretty much every banks have gold loan as the most profitable product.
And I think in the south of India, it's the most popular anywhere in the world, in Kerala, if I'm not mistaken. Kerala use gold loans more than any other state.
That's true. I think most gold loan companies also come from Kerala.
That's a strange thing. I should know.
I think I had heard they had some 45 gold loan companies out of one small state.
I think at one point it was something like 75 registered gold loan companies.
In Kerala? Okay, then you must be right then. I heard.
I understand.
No, but you know that part, right? That 65% of gold loans go default.
Absolutely.
So, because it's the most unplanned loan people get into, and they have no planning of repayment. And these are all done in an emergency situation, and 65% to 70% default. So these banks, first of all, for gold, I keep gold with you. You pay me 90% of the value, very rarely 95%. So I already lose 10%, right? And I get 70% of it. And out of that, I may have paid back 20-30%, but because I default, I get nothing.
You get nothing. So this is why the concept of tokenization and atomically swapping assets is so incredibly powerful.
And it can be a layer of insurance for the borrower.
Absolutely. Right? It can be a layer of insurance. It can be a layer of liquidity. It can be a layer of new business models. And it's all been powered by the fact we now have this technology called blockchain, which before blockchain became into existence, the atomically swapping of an asset.
Well, I'm gonna reach out to you after this, try to see if you can push this, because I've been talking to so many people. I'm not able to get across to them to understand how this is so useful, particularly for the gold loan, because banks are benefiting, borrowers are struggling, suffering.
Absolutely.
And politicians don't seem to understand it.
Well, but this is the problem I have with most policymakers and most politicians. They're not technologists. And this is one thing. Technologists
No, but this is business, right? This is economics. This is not technology.
You need to understand this technology, and most people in policy positions don't. And this technology is so revolutionary, and where we're seeing Web 2 and Web 3 come together, because as I explained on our last conversation, now over open networks, we can transfer information and value. And we've never seen that in history. So these new business models, these tokenization of real world assets is going to be so powerful in the next 10 years. But the issue is as well, you have to be very careful which protocol you're doing it on blockchain, and be careful who you're using, because in a lot of the pilot cases I've seen, the technology is not right there yet. And the proof of ownership of that underlying asset becomes very difficult. So when you're looking into these different models, you need to have somebody that understand.
How about a hybrid here, a private chain and a public chain? I mean, this is what I recommend, because I think it gives a view where something needs to be plugged into, assuming that tomorrow government will come in and they will want to plug it into their system. So that is where I'm trying. I think this is the best way to prepare for, be ready to the compliance ecosystem.
So everybody tells me that in the world of institutions and governments that private blockchains are going to be better. Okay, don't call them a blockchain, because it's a public blockchain is something like the Bitcoin network. Anybody can join the Bitcoin network. The source code is written on the internet. You can go, you can plug in. But in a public blockchain, you have to agree to the rules of the network and the protocol. You can't change the rules just because you're a big player in it. Everybody.
We also talked about public chain strength depends on the governance eventually, right? So governance failed. We had those biggest stuff, the scams recently.
In public blockchain, the governance models are particularly important because nobody is in control. But there's a trade-off. So public blockchains are incredibly secure. They're the most secure databases that we've seen because they're so decentralized, because you've got so many millions of people using it.
No,
So
but it still comes down to the governance, right? If the governance fails, technology fails eventually. Because we just saw that.
I don't think the governance model of something like Bitcoin would ever fail. Bitcoin is the biggest blockchain. It's been around for the longest.
No, not just from the chain point of view, but of course, technically it was not a public exchange, but that exchange failure was primarily a governance failure, right?
Well, FTX has nothing to do with blockchain. FTX was a
It's nothing to do with blockchain, but it was a governance issue. So
it was a centralized exchange that could have, quite frankly, been trading jelly bean derivatives, but it wasn't regulated in any way that a centralized intermediary like Wall Street had been regulated for the last 100 years. For some reason, the FTX guys were allowed to put blockchain and Bitcoin and a digital asset in a conversation, and everybody.
No, but it's the same argument, right? Like what Buterin intervened at the time of Dow failure and just wiped off that $200 million scam, saying that it didn't happen. So technically, see, this is the same argument with the government. See, the argument is it is for the general good. But the thing is, who decides on the general good there? So the governance is still important.
Bitcoin, the governance of Bitcoin is never going to be broken. And I will argue with you to the degree. But listen to me.
Bitcoin, fine. What about the rest of them?
So Bitcoin as a public blockchain is the most secure, the most secure public blockchain there is. Security is, the people that created Bitcoin built it for the fundamental reason was security. It added a security layer protocol, as I described in the last podcast, onto the internet. It's the most secure blockchain that's around. Now, there is always a trade-off. There's always going to be a trade-off between privacy and security. Now, when banks or private institutions are running blockchains, and I would now change the terminology, because I think calling a private blockchain is the wrong word. It's a private distributed ledger, because a blockchain is just a fancy word for a database.
Essentially a distributed ledger, yes.
But a blockchain is a blockchain can be applied to something like the Ethereum blockchain or the Bitcoin blockchain because they are public. Anything that it is not public, and there are certain, but when people look at using blockchain solutions, I always say to them, be very careful. Why do you want to use a blockchain? Blockchains are the most inefficient databases in energy intensive that we could ever use. You may just need a better encrypted database. If you're worried about security, use a database like you use every single day and just encrypt it better. So there's a big misnomer that everything requires a blockchain. And that's certainly not true. There are instances, when banks or private institutions are interacting with each other, if there's a whole lot of people in a group that need to transact and they don't trust each other, that is when you need a blockchain. So when you have more than 3 parties or 4 parties.
So how do you see now generally approaching enterprises and government adoption is essentially through private chain? So what is your argument then? How do you see the enterprises and government agencies adopt to it? If you say it has to be, if it is not private chain, then it's not a blockchain.
It's a distributed ledger. If it's a trade-off. If you're worrying about privacy and not security, if security is not your major concern,
but we can always have a hybrid, right? We can have an external facing public chain and an internal facing private chain.
So this is why,
or a DLT, if you will.
I don't like the word DLT because I
but you don't like to use private chain. You don't like DLT then.
But I've never seen a DLT work. To be in complete honesty, the only blockchain that I know that works at this point in time, the only blockchain is Bitcoin. And I say that with 100% guarantee. There is pilots, there is issues, there's scalability, throughput issues. But I think what we will see as the technology gets better, you will see, because not everything needs a public blockchain. Banks and government entities, they shouldn't be sharing all information with millions of nodes out there on a public net. That's ridiculous. That makes no sense. Correct. So there's a trade-off always between security and privacy. If privacy is your major concern, you don't need a public blockchain. If you want the most secure database in the world, you use a public blockchain. But now what we're seeing, these new layer 2 protocols are being developed on top of public blockchains. Like Bitcoin, the next layer there's something called the Lightning Network. The Lightning Network was built on the original protocol of Bitcoin, and it solved a lot of the scalability and throughput problems of Bitcoin. Many, many different protocol layers are now being built on top of Ethereum. So what I do see is exactly what you said.
But Lightning Network is core of it is DLT, right?
No, it's completely open source. It's completely on the. I know the two guys that built it, the architects of this system. Johnny Diller, they came out of a company called Blockstream. It's completely decentralized. And I like the Lightning Network because it solved...
I'd like you to connect me to them. Okay.
There's lots of problems with the public blockchain, but I think what we're seeing now is this hybrid. So people will use the security of the public blockchain, but they will use the privacy of having only a certain number of nodes in the system. Because when we look at blockchains, if there's in Bitcoin and Ethereum, there's like millions of nodes, but in private blockchains, there's only a certain number of nodes. And if you're comfortable sharing information, in a network that, say, a group of banks that there's 9 nodes, you do compromise your security. You keep private, but you do compromise your security because one of those nodes can have an attack and take over the other nodes. But I think for the case of what we're seeing, an institutional adoption, you will need to have some sort of private chains that are linked to the security of these public blockchains. So there will be hybrid forms that are working, but to be honest, to date, the technology is still not there. The interoperability that we're seeing, every JP Morgan have tried to build their own private blockchain. You had Elon Musk is trying to build one now. The quantum computer guys are trying to break the public blockchain and they can't do it. Quantum computing, there's always an argument that in 50 years it'll break the code.
Probably lesser.
I don't think it ever will. And the reason I say that is because the more decentralized the Bitcoin network comes, the more solid and secure it becomes. And I've had these arguments with people that have built, that build nuclear facilities and build cybersecurity, second protocol layers. And I don't think the quantum computing guys are going to get there. Private chains, of course, they can break them now. They can break them in 5 years. So it depends on what your requirement is. Is it privacy or is it security? You can't have both. And that's the fundamental difference between a DLT, a private blockchain and a public blockchain. The more decentralized the blockchain is, the more public it is, the more secure. But it's not private, and if you want the chain to be private and you only want a certain amount of institutions or government bodies to use it, it's going to be less secure but more private. So it's a trade-off. Everything in life's a trade-off. This is a big one.
So then metaverse.
So the metaverse is an interesting one. So I've been watching the metaverse from afar. I watched Mark Zuckerberg come out and say that Facebook was going to.
So what do you say for this statement that metaverse is not necessarily blockchain?
So metaverse is a combination of many things, but it may not necessarily need blockchain solutions, but it needs a digital asset, and digital assets come out of blockchain technology. So there is an interconnection. So the metaverse is not just a private metaverse. There's thousands of metaverses. There's decentralized metaverses, and there's there's private metaverses. Mark Zuckerberg seems to own one that he doesn't want to own anymore. I think he changed the whole name of Facebook to something called Meta, which he's now, I think, feeling very sorry he did. But so we're seeing...
No, not just that. Oculus, they renamed it as Meta.
Yes, so he's got his own metaverse, but there's a whole lot of decentralized metaverses, and the metaverse is just this. If I can break it down for people that are curious like me, and I'm old, and I always break down, break things into the most simple explanation I can give. So I live in this world. I live in the real world. I'm Loretta Joseph. I have a driver's ID on this. I have a bank account that says I'm Loretta Joseph. In the metaverse is a digital representation of this world, but in a digital world. So the world that I can live in digitally is the metaverse, and I have a digital ID, a digital twin. I'm still not convinced I can actually live in this world full time. So how I can manage myself and a digital twin in the metaverse remains to be seen, but there's people that do it. And so you're seeing these interactions, and I guess with lots of the younger generation that were gamers or use virtual reality headsets.
So how far do you see metaverse will break out of these dependencies of these gears? Because right now it's self-limiting, right? The hardware, yeah.
Yeah, so the hardware is becoming, and I've set up something called the World Metaverse Council last year in October with a number of government agencies, a number of people, and I wasn't so convinced, to be honest. Now, as the World Metaverse Council, we've got 10,000 members, 179 countries and 47 governments. And this has been in 6 months. So I
think it's the hype which is driving it.
Yeah, but I can't look at it from the hype of what I think. I'm almost a 54-year-old woman. I live in the real world, and I've been taught. I've been taught to live in the real world. I didn't grow up with a mobile device or even a computer.
No, but even how many will be able to live with the device dependent, right? See, the limitation of metaverse today is device.
But these hardware devices are becoming extremely sophisticated. I was in Saudi Arabia 3 weeks ago for a metaverse conference and a standards conference. There is devices which are coming out which you can slip into your ear that you wouldn't even know. So that you traditionally, to get into the world of virtual reality, you've had to have these huge headsets thing and you walk around and you jump into things. That was never going to work. But the concept of the amount of people in the world, so you think of the world, there's 8 billion of us. Over the period of COVID, we all had to go and sit inside in small rooms. I have now a 19-year-old daughter. She didn't go to school for 2 years. She sat in front of a Zoom screen and lived on her computer and could walk for 1 hour outside a day. She was not unusual. The entire world went like that. So she reverted to interacting with this. To all her friends, her entire life became digital. You look at countries where the business models were so disrupted by COVID. New models had to be developed, because if you looked at places in Africa or in, say, the Philippines, where most of the population were exported workers on construction or in hospitality, what were they going to do? So these new business models were created out of a generation that needed to make money. So we saw this interesting new phenomenon of what was called pay to play. So people could game, and just for the audience, this is a really interesting one. I mean, I've never been a gamer. I've never been one that looks at, I never even played, Pokemon when I was a kid. So, this was wasted on me. But there's almost 4 billion. So that's almost half the world's population are gamers. You think about that for a sec. You think about the populations of the world that kids are under 26, and that includes India. So these kids have been conditioned, some of the millennials, that Generation Y and Z, and I think this one's A, that they've been conditioned to be digitally active. To live in
digital
the world.
natives, right? So.
Digital natives. So there's many of these, but these new systems which came out of virtual reality, these pay to play, actually ended up feeding a lot of populations around the world in a time when COVID destroyed.
It did.
What we.
Well, incidentally, one of the stories is it was not a young person. It was a 40+ man and his wife who lost their jobs. They had to feed. They heard about it. So they played pay games, and they actually made a living out of it during the COVID. So that is somewhere in Indonesia or Thailand somewhere.
Yeah, so Indonesia, Thailand, the Philippines, and a lot of Africa. These kids were becoming
Africa. That's the full-time job, right? There are people who just pay to play, and play to pay, not pay to play.
That's it. But so we can't discount that the world's changed, and just because we don't do it doesn't mean that people don't. And so we've done studies in the World Metaverse Council. I also chair the Regulatory and Policy Committee. I've had to speak at events in the last 6 months in global institutions and bodies that I would never have dreamed that would have ever invited me in to speak. I've spoken at the OECD, I've spoken at the IMF on what business models look around in the metaverse. I've had Citibank tell me that they're now going to be a metaverse bank. And that to me was like, okay, explain to me how that works. Because when I try and move money from a bank, it takes minimum an hour, maximum 5 days. How am I going to interact in a virtual world with fiat currency? We need digital assets. So that's the underpin of where in the metaverse digital assets are used.
See, I have some friends who are building some metaverse for a bank in India. And I did ask him, so what exactly are you talking about? And he said, yeah, check it out and wear the gear and say, we've created a bank in the metaverse. So you interact with the branch and you do that. I say, why on earth would I want to do that? I mean, it's so consuming. I can just do it over phone in a minute.
Because we cannot, when we're looking
It's just a fad. It's just a fad that you wear the gear.
You're a certain
something more than that.
But yeah, this is the thing. There are governments that actually have set up offices in Dubai. There's the Minister of Finance takes meetings in the metaverse because they have 100, however many people live there, whatever the population is in Dubai, they all have a digital ID. Everybody, it's easier for them to interact in the metaverse with the minister than it is in the real world. So
see, I don't say there are not cases for metaverse, but bank for a consumer does not make sense.
I agree.
Gaming, yes. Interaction with a larger team makes sense. You want to use town hall for a large office with multiple offices. Metaverse is a place to connect. You don't have to travel everybody to one location. You're all meeting in one location. So education, travel, tourism,
climate change.
events.
We can do training now on
training is a fantastic use case, and even these summits and events and networking sessions, all these things are a great opportunity. But
because we did a study, and I think banks are just trying to keep relevant. Banks, but then again, banks didn't become irrelevant.
Yeah, but finally he did tell me that, what do you care? Yeah, I think you should just use this to make money.
It's an interesting one, but they say by 2029, 49% of the population will live more of their lives as we do now in a digital life than they do in the real world, because we're becoming so disconnected as society. We've now, after COVID, the mental health issues and the generation that we've created out of this pandemic has changed the way that we will do everything forever. I mean, I have a daughter, she was telling me she's doing law at Sydney University, and she rang me this morning because she lives there. She doesn't have any lectures on campus. She does everything still online. And I said, well, why am I paying for it?
She lives in the campus.
She lives in the campus, but she has no lectures on campus.
Why? Where is this? Which location?
Sydney University.
Sydney? Why still? Why now?
Very good question. That's a very good question I was asking, but at least she's interacting with other kids that are living there. Because if she was sitting home with me after 2 years of sitting in front of a computer and doing it for another 2 years, and, it's such an interesting place that we've put the next generation. And this pandemic and business models, those that are coming out of the metaverse. I deal with a kid that has shown me this metaverse. It's all the whole world that can go into COP. So we can go into an immersive environment around climate change for every planet in our solar system, and they can now do regenerative tests in the metaverse on things like supply chains. So it's actually it's solving problems that we need in the real world in the metaverse. So I think the use cases that I'm starting to see, and I was very skeptical, I have to say, I was so skeptical of this, but some of the use cases I'm seeing and some of the problems that we're solving for the real world in the virtual world is unprecedented. I was looking at how we can make food, biosecurity of food. And I tell you, if we look at the world as we see it today, we've got lots of problems. We've got geopolitical issues. We've got biosecurity issues around food. We've got more
food security, water security, or availability.
And we, as the generation I'm of the millennials and the Gen Xers and the baby boomers, we have a lot to answer for because we've destroyed this planet. Unless through technology and through the kids that need to use technology, we fix the problems. We're going to have nowhere to live in 10 years. We're not going to have a planet. So, we'll all be living in the metaverse off Mars. So, it's a very ironic thing that we're solving the problems that we haven't bothered to solve for the last hundreds and thousands of years. We're now having to solve in a virtual reality experience because we've got nowhere else to do that. So I think the metaverse is creating new opportunities because, okay, my daughter's at university doing law. Is that really going to do her any good in 5 years in the way that the world's moving with smart contracts? No. So I think things like the metaverse creating new jobs and new skill sets that people that are going to spend the majority of their life in this virtual reality world are going to become really new business models. And we're going to see, again, assets and business models created that we haven't even contemplated. So you combine the metaverse with AI, with Web3, the transfer of value and information. The world in the next 10 years with the technology developments that we're seeing is going to be vastly different from where we sit today. And I can't keep up fast enough writing, new regulations because to me, and what am I seeing in the metaverse? The bad actors that act here are acting in the metaverse. We're seeing people hijack people's hardware and be able to influence their political decisions. We're seeing, coders affect kids with the way that their minds are working. We're seeing kids being exploited, child exploitation. We're seeing money launderers come in because they can go in with the token in the metaverse, move it around and go back into the financial system in the other way. So all the problems that I see now in the world of crypto and digital assets have just been magnified by 1,000 in the metaverse. I had, an interesting conversation last week with a very large global law enforcement agency, Interpol. Interpol have had to come into the metaverse because they're getting so many requests and they've got so many problems. They had to open an office in the metaverse. So you can be skeptical, but I always look at things now with a broad and open mind because everything I learned was in a book. Everything my daughter learned was in a book, and she has a better understanding of risk and a world that I wasn't brought up in. But when we're writing rules and policies, we have to consider that generation and the generations after her, because I'm not writing rules for me and a bunch of baby boomers. And this is why I get so upset with policy writers, because all they can do about regulations and law is look in the present. We can't be looking in the present. We need to be looking at where the metaverse is going to be in 5 years. I mean, I can order my McDonald's.
And for now, at least they should look at FutureFast to get a sense of it.
But everybody should. We all as a collective have a responsibility as human beings to understand where the world's going to be in 5 years and how we can remedy the mistakes that we've made with our technology and how we can harness technology for good. And look how this is going to be 10 years in front of us, not 10 years behind us.
Loretta, thank you so much. Maybe we overshot by 2 minutes for your thing.
Oh, it's okay.
Or a little more than that. Okay, wonderful. So thank you once again, and we'll get you soon back to do the future, really looking into the future, and probably 5, 10, or if possible, even little 30 years into the future. And and also we'll try to get you to make some predictions. So please do think about it. What predictions you want to make?
I could ask for one right now. Is get somebody out there, some very bright, smart kid. Can somebody invent a machine that allows me to go, teleport across countries instantaneously? Because me flying in planes at the moment and the lifestyle I lead living on planes is not good for me. So can somebody invent a way to teleport me?
Oh, well, if it's only to meet, then metaverse is good enough, right?
But I see this is the issue I find as well. I don't think, for me, I went to a meeting on Friday. I went to the Financial Action Task Force meeting, the first one in 3 years. I've done all the Zooms, and
there's not. It's not equal to meeting people. Completely agree with that.
It will never. A Zoom meeting is never, ever going to replace meeting people in person.
Yeah, see, for me, most enjoyable thing of these events are what we do the talking, not on the stage,
Yeah,
but over a coffee outside.
I
That's where
agree.
you actually get.
But we're human. We need contact. We're not machines yet, but we need human interactions. And I always say about AI, the one thing that I hope stops AI getting to the point where it does take over us as humans is, what about someone with dementia? How does an AI read what happens with the next move of someone with dementia? It'll never be able to do that because it doesn't have the emotion. And as long as computers don't have the emotion, that's going to be the only thing that we're going to hold on to as the human race.
I don't know. Sometimes I think it's probably a lot easier to teach a machine patience than a human patience to deal with people with dementia.
Yeah, but I don't
uh,
know how a machine will ever deal with someone with, say, dementia. Like, if they
uh,
don't, like,
uh, yeah, no, I
how
agree with that argument, but that's where I was thinking that it's probably a lot easy to tell machines follow the rules. We can always write algorithms, a set of rules for the machine to not to immediately react, take it into consideration the previous arguments, which we humans tend to forget. Humans, first thing humans do is react. So machines can actually deal better with people with dementia than we, because we carry our own baggages of today's experience. I mean, I live with somebody who's got dementia at home, right? Go back, and it takes time for us to switch off and switch on with them
yeah,
in the
but you
context when
don't
we
have the
go. So
understanding.
perhaps if I were a machine, I would deal with it a lot easily than a human, because I need to switch on, tell myself, okay, right, and then engage.
But
So,
I think that comes down to love and hate. A computer's going to get that, and AI algorithms that good that they understand the difference between love and hatred.
so
Were
for more of this
they ever going to be able?
conversation, for more of this conversation, wait for the Friday episode with Loretta on that. And I'm sure you enjoyed this. And please feel free to share it across with people, those who are not clear about a whole lot of things we talked about, right? Private chain, public chain, NFT, metaverse, tokenization, and decentralized, and of course Loretta's opinions on the limitations of DLT, or on the thoughts on how enterprises can work with hybrid, if it has to be in hybrid, or one should even question whether do you really need blockchain, and if you need, for what. So wonderful conversation. Thank you so much, Loretta. I'm sure
Thank you.
everybody enjoyed it, and I'll come back to you for the third one. And until then, all of you enjoy the ride.
Bye. Thank you so much.